Welcome back to Smart Stock Sam, the channel where we cut through the noise and give you the data that actually moves markets. If you are here, you already know that NIO has been on an absolute tear, and today we are going to show you exactly why the rally that we called a week ago is not slowing down. It is just getting started. If you landed here because you saw NIO's name trending and you want to know whether this rally has real legs, or if you already own shares and you are wondering exactly how high this thing can run next week, you are in exactly the right place. Today, we are walking through the full picture. The fundamental transformation that silenced the critics, the explosive delivery numbers that shattered guidance, the infrastructure that nobody can copy overnight, the institutional smart money flooding in at historic levels, and a very specific price target roadmap for the week of April 13th through the 17th. And stay until the end, because the options data alone tells a story that could completely change how you position yourself heading into next week. Let's get into it. To understand why everything changed, you first have to understand the old story. For years, the bear case on NIO was almost too easy to make. High cash burn, massive losses every single quarter. A business model that required you to believe the company could build, operate, and monetize thousands of battery swap stations before running out of money. Critics called it a money pit. Analysts flagged bankruptcy risk in their reports. And honestly, back then, those concerns were fair. That was NIO 1.0, a startup betting everything on a vision that had never been proven at scale. But here is what the bears missed. Every dollar NIO was spending was quietly building something that is now incredibly difficult and expensive for any competitor to replicate. And right now, in real time, we are watching the market wake up to that reality. The shift happened across three pillars at the same time, and that triple alignment is exactly what makes this moment so significant. First, the fundamentals flipped in a way that removes the single biggest risk that was capping the stock's upside. Second, the operational execution is not just good, it is shattering the ceiling of what even the most bullish analysts had modeled. And third, if you are a technical trader, the chart is screaming one of the cleanest setups we have seen all year. When all three of those things align together, that is when you get the kind of momentum that does not just last a day or two. That is when you get a genuine repricing event. Let's start with the number that silenced the critics, $40.4 million. That is NIO's GAAP net profit for the fourth quarter of 2025. Read that again slowly. A GAAP net profit, not an adjusted number, not an operating metric with 17 footnotes, a real, audited, bottom-line profit. For years, the bears built their entire thesis on the idea that this bar would never turn green. They were wrong. And what makes this so important for investors is not just the accounting win, it is what it signals about the entire business model. Premium pricing works. The infrastructure investment is paying off. The margin strategy was not reckless spending. It was deliberate foundation building. And once the bankruptcy risk disappears from the conversation, the market is forced to completely rewrite how it values this stock. That re-rating process has already started, and we are still in the early innings. Now let's talk about what is happening on the roads, because the delivery numbers are where the story gets almost hard to believe. In March alone, NIO delivered 35,486 vehicles. That is a 136% increase year over year. For the full first quarter, total deliveries landed at 83,465 units. Now here is the key context. They did not just hit their guidance range, they blew past the upper end of their own estimates. While other EV companies are writing press releases about macroeconomic headwinds and softer than expected demand, NIO is going in the completely opposite direction, accelerating when the competition is decelerating. That kind of divergence in a high interest rate environment does not happen by accident. It happens when your brand has reached critical mass and your customers are choosing you over everyone else on purpose. But here is the part of the NIO story that gets underappreciated in most coverage, and it might actually be the most important long-term competitive advantage the company has: the infrastructure moat. Right now, NIO operates over 3,800 active battery swap stations worldwide and has crossed 100 million cumulative battery swaps. That is not a pilot program anymore. That is a proven operating network at massive scale. And the thing about infrastructure is that you cannot shortcut it. Tesla cannot wake up tomorrow and build 3,800 swap stations. Xpeng cannot either. This took NIO years and billions of dollars, and it is already built. What makes it even more powerful going forward is that they are currently deploying fifth-generation stations specifically designed to support the incoming Firefly mass-market brand. The network is not just serving today's customers, it is being pre-built for tomorrow's volume. That is how you create a competitive moat that compounds over time. Now let's zoom inside the car itself, because NIO is also making a move that investors need to understand. They are going vertical on silicon. The Shenji NX9031 chip, which debuted in the flagship ES9, is their first fully in-house autonomous driving processor. Think about what Apple did when it moved from Intel chips to its own silicon. The performance jumped, the costs dropped, and the dependency on a third-party supplier disappeared. NIO is running the same playbook. By owning their own chip, they control the full autonomous driving stack, they eliminate the revenue line going to NVIDIA, and they set themselves up to dramatically reduce per-vehicle costs over the next several years. In a price war, controlling your own silicon is not a luxury. It is a survival strategy. And speaking of margin strategy, the way NIO has structured its multi-brand model is genuinely clever. Think of it as a margin cascade. The premium flagship models, vehicles like the ES8, are generating roughly 25% gross margins. That is a serious amount of cash coming in from customers who want the very best. NIO then takes that premium profit and uses it to fund the development and market launch of Onvo and Firefly, their mass-market brands. This means they can attack the high-volume, lower-price segment of the market with cutting-edge technology without ever having to dilute the prestige of the core NIO brand. It is a self-funding ecosystem, and when Firefly launches with a pre-existing battery swap network already in place, that combination of brand, tech, and infrastructure creates a wall that is very hard for competitors to climb over. When a business model starts working at this level, the institutions notice. And the institutional data for the latest quarter is about as clear a signal as you can get. 190 different institutional investors added to their NIO positions. The net result was over 5.2 million new long shares added to institutional books. But look at the conviction levels from specific names. D.E. Shaw and Company, one of the most sophisticated quant funds on the planet, increased their position by 248%. J.P. Morgan Chase increased their stake by 268%. These are not passive index adjustments. These are deliberate, high-conviction bets being made by some of the smartest money managers in the world, and they are timing those bets almost perfectly at the moment the bankruptcy narrative died. When you see accumulation like this, history tells us it usually precedes a major repricing move. So, where are the analysts pointing the price target? The median Wall Street estimate currently sits at $6.80, which, by itself, represents meaningful upside from current levels. But the more interesting call comes from BOC International, who recently reiterated their buy rating with a price target of $14. Their thesis is that NIO is entering a scalable, profitable growth cycle that the broader market has not yet fully priced in. If that $14 target plays out, we are talking about roughly 115% upside from where the stock is trading right now. Is that going to happen in a week? No, but it tells you the size of the runway that the bulls are working with. But before we talk about next week's setup, we have to walk through what happened in the last two trading sessions, because the price action was a textbook lesson in market psychology. On April 9th, during the ES9 launch event, the stock actually dipped 4.86%. That was a classic sell the news reaction after a massive 27% monthly run leading into the event. Some investors were spooked by the premium 528,000 yuan price tag on the new flagship. But then, April 10th happened, a 7.08% single-day rebound, closing at $6.50. What fueled it? CEO William Li publicly projected 40 to 50% full-year delivery growth. That kind of forward guidance in this market environment is rare, and the stock reacted exactly the way you would expect when a company is visibly outperforming its peer group. For the week of April 13th through the 17th, here is the specific roadmap. The optimal entry zone is between $6.45 and $6.55, which sits right on top of the $6.46 moving average support level. Immediate support below that is at $6.25. The first meaningful resistance to clear is the pre-market high at $6.63. If the stock reclaims and holds above that level, the next magnet is the heavy wall at $7. And the ultimate bullish target for this run, based on the momentum structure, is the $7.50 range. Technically, NIO is currently trading above every major moving average: the 5-day, 10-day, 20-day, 50-day, and the critical 200-day. When a stock clears its 200-day moving average, that is not a minor signal. That is a long-term trend reversal confirmation, and it tells you the bulls are firmly in control of the tape right now. The options data adds a very interesting layer to that setup. The put-call ratio is currently 0.34. That means for every 100 call contracts being purchased, only 34 put contracts are being traded. Market makers are positioned overwhelmingly on the upside. And here is the detail that could turn a normal rally into something much more aggressive. There are currently 146 million shares held short, and there is a massive concentration of call open interest sitting at the $7 strike. If the stock clears $6.63, it could trigger a vacuum effect towards $7 as short sellers are forced to cover their positions all at once, potentially creating a squeeze that accelerates the move far faster than the technical setup alone would suggest. Now, before we go any further, let me be clear with you, because this is the part of the conversation that actually matters. Everything I just shared is for informational and entertainment purposes only. Nothing in this video is financial advice, and nothing here should be taken as a recommendation to buy or sell any security. Investing in individual stocks, particularly in emerging market growth companies like NIO, involves significant risk. You can lose money. Markets are unpredictable. Always do your own research. Always consult a licensed financial professional before making any investment decisions, and never invest more than you can afford to lose. Smart stock. Sam does not hold any regulated financial advisory license, and this content is not a substitute for professional guidance. With that said, let's bring this home. The money pit narrative is gone. What we are looking at now is a profitable production machine with a defensible infrastructure moat, in-house silicon, a multi-brand margin strategy, explosive delivery growth, and some of the most sophisticated institutional investors in the world taking large, high-conviction positions. The macro environment will always have noise. There will always be headlines that create short-term volatility. But NIO's transformation from cash-burning startup to self-sustaining growth company is a structural shift, not a headline trade. Here is the question I want you to answer in the comments below. Do you think NIO can hold its profitability streak for 3 straight quarters, or do you believe this is a one-time result that the bears will use to reset the narrative? Drop your honest take down below. I read every single comment, and I want to know what you think. If this breakdown gave you a new perspective on NIO, hit the like button right now. It genuinely helps this video reach more investors who need to see this data. And if you are not subscribed yet, click subscribe and turn on notifications so you never miss a price target update or a market breakdown from Smart Stock Sam. I will see you in the next one.